For our show today, Brad Gerstner, he's the founder and CEO of Altimeter Capital. It's good to see you again.
Hey, good to see you. Thanks for having me on.
So I know you probably heard the conversation that we were just having, and what's most interesting to me about the way that you view the market is when you were with us the end of March, you said you had reduced your total gross exposure, covered your shorts, and were focused on your long book. What you now tell us is that you've been adding to your short book with lower quality software names, you say, and internet names that appear overvalued. Are we talking about those stay-at-home stocks, the very ones that we were just discussing, a lot of these tech names, high-growth ones that have had such a great run?
Well, thanks for having me on. I mean, if you think about it, we're only 180 days since that conversation we had that was pretty scary and despondent at the end of March. And, of course, we said we went all in at that point, covered all of our shorts, and basically we're 100% net long because the Fed had gone all in with its balance sheet. Rates went effectively to zero. And that, frankly, we thought that we would have the ability to get this under control a little bit faster than we have. We thought that we'd have antivirals faster than we've had. That's taken a little bit longer. And what we saw during that intervening period of time was the support out of the Fed that really propped up a lot of these technology stocks, the software and internet complex in particular. Multiples expanded pretty dramatically with those lower rates. And as we sit here today, we think that, it's been a heck of a run for the market. And I do believe, as Jim pointed out, as Scott was just referencing, half of the market's been largely uninvestable for this year. If you were putting dollars to work, you weren't buying airlines, you weren't buying travel companies, you weren't buying hospitality companies. And I don't think we can underestimate the significance of the news around the Pfizer vaccine or the Lilly antiviral. It's extraordinary what this country has accomplished in a very short period of time. And so for us, we started looking at that rotation. We think dollars are going to move out of some of these really terrific software companies and internet companies. We're just going to have a reversion to the mean around some of those multiples as the 10-year and the 30-year start to revert to the mean. We've already seen significant moves out of the long end of the curve. So we're not making some big macro call. We're just saying this is a normal normalization of those multiples. Tech companies are still going to do fantastic. That's, what we're betting on. But at the same time, we think the other half of the market, which most people have not participated in over the course of the last 4 months, will really start to reflect a return to normalization as you start to see it, priced into some of these stocks.
So you do, in fact, it sounds like, think it is time to be selective, but sell some of those stocks that have expanded their multiples a lot since the spring and take a look at some of those reopen, epicenter, cyclical value, whatever you want to call them, the stocks that have a lot of potential upside because of the news of the vaccine and the ultimate distribution of it.
I mean, we're in the business of portfolio and risk management, Scott. And so if multiples expand by 40% and you're not making any adjustments to your portfolio, right, to massive binary events like the announcement of probably the best vaccine ever produced, right? That would be us failing to do our job. So we're not changing the companies we love. Our top five have generally been the same top five for well over a year now. But on the margin, we're managing our exposures, to take advantage of what we think will be a rotation back into some of these stocks which have been uninvestable. As you know, this move has been happening. The bond market, the 10 years, 90% off of its lows, right? The 30 years, 50% off of its lows. But there's still a significant ways to go before we revisit January 1st levels. And the inverse to those higher rates on the long end of the curve is lower multiples on these high growth stocks. So that's a natural phenomenon. We're not, we don't have any panic around these terrific companies. Zoom is a world-class business, is going to be a world-class technology platform for a long time. But I think prudent portfolio management would simply say that you manage out of some of that exposure into some of the companies which have failed to capture a bid for most of the year.
What do you do with Snowflake, which I know you like very much? You were in very early. Is that sort of one of these I don't know, what did it go public? 100 times sales? Is that one of the kinds of things we're talking about in the space of software, which you and I have had a conversation about for the better part of the last 2-3 years?
Well, let me first say that, the one thing that I want to celebrate is you and I would have never predicted 180 days ago, right, that the internet companies that power this economy would have kept us all connected, would have kept all of our shelves full, that the software companies would have so seamlessly kept our businesses running, that the government would have done its job with respect to liquidity, or at least the Fed did its job. Frontline workers kept people moving. We had the greatest election turnout in the history of this country in the middle of a pandemic. And now our biopharma community has delivered a 1-2 punch with more coming. That's the greatest rate of innovation around bioscience that the world has ever seen. And so with that as the backdrop, when we look at these software companies, we're certain that the digitization of corporate America has been pulled forward. We're certain that the rate of growth over the next few years will be higher than it would have otherwise been, because there is not a CEO in America now that doesn't understand the need to move their technology into the cloud and to be a digitally hybrid environment. But at the same time, you have to pay attention to the price you're willing to pay today. As Warren Buffett says, your returns are greatly impacted by the price you pay to get in. When we look at Snowflake, we think it's going to be one of the most extraordinary, it already is, the largest software IPO in history. And we think it's positioned to be one of the most impactful and iconic technology companies of the next 10 years. We think of it as the fourth cloud. We think all data will ultimately, for most businesses, will reside there. And the connective tissue that they'll provide to help companies derive insights out of that data will be second to none. So we're huge believers in the long term on Snowflake, and investors will have to make their own call on the multiple that they're paying today for those earnings.
So I wouldn't
pay that much attention to the next 12 months. You and Cramer like to talk about 100 times sales, but when you are analyzing a company that's growing over 100%, which with such low penetration of its TAM that this company has, you really need to look out 3 years to figure out what you're really paying for the business. Compare the multiple 3 years from now with the multiple of the rest of the software complex, and it looks far less onerous.
Only, I think, Brad, because it just speaks, or at least it spoke at the time of its going public, of a narrative that had gripped the market, that people were willing to pay up for the kind of growth that a Snowflake would deliver. Not an indictment of Snowflake or its CEO, Slootman, in any way, shape, or form. It was just sort of the psyche of the market at that particular time was the reason why I think those comments were relevant. Here's what I want to do. One of the members of the investment committee, Tiffany McGee, because of the comments that you just had, I think are very interesting. She bought more, Tiff, you bought more ServiceNow. You bought more Salesforce. Since we're talking about the cloud, you bought more DocuSign. I'd already mentioned that you had bought more Peloton. Can you explain the reasoning behind those moves? And look, I'd like to get Brad's opinion on making the moves in names like that right now, given what he just said. Tiff, the floor is yours.
Yeah, sure. So listen, at the end of the day, I invest in innovation and strong management. And so, we have these conversations around valuation. And again, I don't think that we can have that same conversation using the same metrics. We have to consider the time that we're in. And we were talking about earlier that these things are not going to go away. I find myself, again, asking not, I want to get things for the best price, but some of these things I just have to be in. So when I see the dips, I'm going to buy the dips. And so I'm also not a trader, I'm an investor. And I see all of those names that you mentioned, Scott, as good opportunities for the long haul. And so these are not, for the most part, these are not companies with 20 and 30 competitors that are exactly the same. These are companies that are really strong leaders in their markets, and they're dominating. And they've really kind of kept us through during this entire year. And I don't think that's going to change when we do have a vaccine that everyone has taken. Okay.
Investing Professor Gerstner, what grade do you give to the explanation of the thesis of why Tiffany just bought the names, despite some of the noise within the market that we're seeing around them.
I mean, like Tiffany just demonstrated why she's a great investor, right? She's looking at this as an owner. She's going to hold these for a long time. She doesn't have any idea. I don't have any idea what they're going to do over the next 30 days. But if you have the perspective of whether or not those are terrific companies, ServiceNow, DocuSign, extraordinary companies, aren't going anywhere, terrific business models, great management teams, right? And if you're willing to tolerate some mark-to-market loss on it because multiples may continue to compress, then I have no problem buying it. What I worry about are Robinhood traders, right, who've been rewarded all year long buying every single dip, who failed to understand that we have an event now that is likely to change the course of the long end of the market, right, is likely to cause the Fed sometime in 2021 to take a harder look at the liquidity situation and the short end of the curve. And that does impact multiples. But if your time horizon is long enough, then all of those companies are terrific buys. And let me just also say, right, this correction has been occurring, Scott, for several weeks now, right? I'm just looking at our dashboard, right? Zoom peaked at 21.6 times, right, forward revenue. Today, it's already back to 14.6 times. And pre-COVID, it was at 13.6. So we're almost back to the multiple on Zoom that we were pre-COVID because the earnings power of the company has come up so much over the course of the year. If I go down the list, Shopify peaked at 21 times. Now it's at 16.7 times. Pre-COVID, it was at 11.7. So buying today is certainly not buying the top. A lot of the correction has already occurred. We believe that, this rotation is going to continue, but investors shouldn't think that they're smart enough to bottom tick all of these companies. They should have their wish list, and they should have a deliberate plan to buy on this path downward so that they can get to their full position, somewhere at a reasonable and fair entry price.
When was the last time you added to or thought about adding to an Uber, Expedia, or United, given the conversation that we're in right now?
We've added to them at several points over the course of the last couple months. I think more importantly, I was one of the crazy ones who back in April, as you know, thought that we would get to the other side of this. And so we had a lot of those positions back in April. As you remember, I raised, in fact, a special purpose vehicle simply to buy those names. And I said, I don't know whether we're going to be on the other side in 6 months, 12 months, or 3 years, but I do know we're going to be on the other side. And that special purpose vehicle is up over 100% off of where we purchased those stocks in April. And so, again, it's knowing your investment strategy, committing to an investment strategy. I think today buying Expedia at $125 a share is a very different decision than buying it at $60 a share 100 days ago.
How about United? Can you give me a sense of what sort of renewed optimism you may feel about United and how that speaks to maybe the airline trade more broadly for those of our viewers who may not be in United specifically, but do own an American, or Jim Lebenthal, for example, owns Alaska, Delta, things like that?
Well, first, let me just say that I think the airline industry, the frontline workers, the executives running those airlines in the face of massive political pressure have done an incredible job at transforming an industry and getting needed medical workers and others, family members around the country during an extraordinarily difficult time. And so, hats off to every single one of these airlines. My 84-year-old mother flew United out here a couple of weeks ago and flew it back. And, I'm so impressed at what they've done. When you look at the airline industry relative to, say, something like the cruise line industry or relative to an online travel agency, I think that there's a temptation to look at the old stock charts and say, okay, where were these stocks trading last November? I'm going to make a bet that they're going to get back there as soon as we have a vaccine. Here's the problem with that analysis. These airlines have taken on a massive amount of debt, right, in order to survive. And so the balance sheets and enterprise values of these businesses is just fundamentally different. And so you shouldn't anchor yourself to that. With that said, I also think that there are extraordinary moves that all of these airlines have taken in order to right-size their businesses, in order to reduce change fees, to put themselves on a much better competitive footing on a go-forward basis. And so the question one needs to ask is, in a normalized environment, whether that's 22 or 23, is United going to get back to $10 in earnings? And if you believe they can get back to $10 in earnings, then that's going to be a $90 or $100 stock. And that's going to be, up 100% from where it is today. I happen to believe that the human desire to travel, to socialize, hasn't been diminished at all. I watched that Notre Dame victory over Clemson. I watched 5,000 students rushing the field in the middle of a pandemic, both terrified, but also heartened by the fact that, the enthusiasm of people to celebrate, to be together, to travel has hardly been diminished. And so I think we're going to get there. I think that the earnings will be different than they would have otherwise been, right? Take an Expedia, which has slashed massive costs at the same level of revenue that Expedia had in 2019. They're going to be 30 to 40% more profitable. Their profit margins are going to expand by 800 basis points because they've used this burning platform to right-size the business. So, it's idiosyncratic. You need to go company by company. But I'm bullish, as to the question as to whether or not people are going to return to restaurants, return to traveling, return to staying at hotels, I frankly think we have extraordinary pent-up demand. And I think that I can make an argument that starting in June of next year and that 12-month period may be some of the greatest travel demand we've ever seen.